Um, so in this tutorial, what I would like to do is to talk a little bit about the IPO process, because I see that there is substantial confusion on what actually happens, especially with regard to the timeline when you get close to the IPO date. Okay, so let me. So your assignment one is actually due at the start of the lecture. Please hand it in to us before Paul McGinnis starts, because he will discuss aspects of the assignment in his lecture. So it's not very meaningful if you give it to us at the end. We would, he can refuse to take it, or we might have to, put a discount on your answers. We don't know if you were just copying them down during the class. Okay. I want to talk today about these things generally, and I think in order that you don't just look at the slides, it's better I talk to you using the notes to start with, okay? And then I want to go through some in-class assignments. Now, the thing about IPO, so I already told you last time, if you started a business and you're running it for a few years and you're doing very well, then the initial public offering is the natural next step that you take to bring your company to the public. It's a very exciting event. It symbolizes that you now have. So when you become a publicly listed company, when you do an IPO, okay, what you should realize is not only are you're now quite well known, like Alibaba, everybody knows, BYD. There was a company that listed recently called NIO, correct, on electric cars. Okay, so when you list in a stock market, it signifies a sort of milestone in your company. But not only that, okay, the other interesting thing that you have to remember is once you do an IPO. So this was before, and now part of the shares are listed for trading, and maybe you issue some new shares. Okay, now once you've done that, you can come back to the stock market at a later stage, and either you can sell more of your own shares, or you can issue more new shares. You can do that. Okay, so the stock market becomes, an additional source of funds that was not really available to you before. Now, it's not as simple as going to the kitchen and turning on the tap and the water comes out, but that is kind of how you can think about it. You have an additional source of capital. All the documentation is there, the trading platform is there, the investors' recognition is there. Okay, you just make an announcement, get a bunch of iBankers, do a roadshow, bang, that's it. Okay, so you can think of it like that. That is another reason why IPOs is a very is a momentous event. But the timeline, if you like, the timeline is usually like this. So there is the actual IPO date. And I guess many things revolve around this date, happening either before or after. Okay, now let me tell you what happens before. Okay, so long before, long time. So you are here. You are still a private company. Okay, and then now I'm not drawing this to scale, and then maybe you prepare for IPO. So you do all the filing, you file an application for an IPO, you do the road shows and the due diligence and auditing and this and that, okay, and you apply for it. And then closer to the date, okay, you have a lot of sort of price negotiation. Now, what I mean by that is maybe you appointed Morgan Stanley and China Merchant Bank and JP Morgan as your lead sponsor. So they will be calling their investor clients to see whether they have interest in this company XYZ or ABC. Now these clients, so you might have client one. So let's say there's a share and the price range is between $10 and $12. Let's just say it is, okay? So customer one maybe will tell you, all right, well, we are happy to buy 1 million shares at $10, let's say. And then client two will tell you, okay, we are happy to buy 2 million shares at $11. And then client three, different person, may say, okay, we buy 1.5 million shares at the price of 12. Now, different clients have different preferences and they may have different outlooks for the same company. So this is at this moment, a lot of it is just talk. I mean, they are leaving orders to the investment banks, but it's not trading yet because the IPO hasn't happened yet. Okay, so it's like JP Morgan talking to Fidelity or Goldman Sachs talking to BlackRock and then expressing the interest. Are you with me so far? Now, this is kind of what we call the primary market. So it's not really a market as such, okay? It's a lot of people talking on the phone to a lot of people in order to facilitate price discovery, if you like. It's not a market in the sense that, the New York Stock Exchange is a stock market, okay? Now, after that, so the price negotiation and the road shows, and then maybe here, okay, you start taking institutional orders, institutional or international orders, and then you also start you take the retail subscriptions. Retail. So there's normally there are institutional investors, and they will give you orders like this. So you take orders, and then you also try and figure out how much retail subscription there is. Okay. Now, a lot closer to the actual IPO, And when I say closer, I really mean sort of like 1 week before. Okay, so 1 week before. So by that time, maybe here it's just 1 week before, you already know. So by that time, the retail subscription would have finished, and you know how many retail investors are interested in the stock. And if you need to do the clawback, you probably would do that here. Okay. Don't worry too much about whether this is precisely correct or not. I want to just give you an idea of, what happens, boom, 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 A, B, C, D, E, and what happens at what phases. Now, clawback, it's a very, very simple idea, okay? So if a company was thinking to issue, you know, 100 million shares, okay? Let's just say, normally the default, the standard allocation is 90% to international. International basically means institutional. So the institution can be local, but these are fund managers, insurance companies, and so on. Okay, they're not individuals. So international tranche, and then 10% to the retail. Now that is the standard practice. However, if there is a lot of demand from the retail segment, these numbers can change, but they should always add up to 100. Okay, so whatever you take from the international, you put it back into the retail. So if 90 and 10 becomes 80, the other will be 20, or 70, 30, and so on. Okay, I don't know the precise breakdown, but it's the concept that I care about. Okay, is if there is a lot of popular demand in the retail market, you take some of the subscription out from institutional to retail. Okay, is everyone okay with that? Now, things get interesting. So let's say 2 days before, or maybe even 1 day before the IPO, okay, is when you start doing the allocation. Now, do you know what allocation means? Allocation means if a client is issuing 100 million shares and you have orders either from institutional or from retail, it doesn't matter where it comes from for now, but if you have orders for 500 million shares, okay, you got a problem. It's called oversubscribed, right? In fact, it's 5 times oversubscribed. Okay, so not everybody can get everything. Sorry about that, okay? But, well, you look on the bright side, that means this stock is popular, or people think it's a good investment. Actually, 5 times is nothing, okay? Some stocks are like 72 times oversubscribed or something really crazy like that. But anyway, now when it's oversubscribed, then when you allocate, you cannot allocate 500 because there are not enough stocks to go around, okay? You can only allocate whatever was stated in the prospectus, which was put out basically somewhere around here, okay? So when you go on road shows or when you see clients and you give them a prospectus, and you must have seen in some of these prospectuses that Paul McGuinness was showing, there is a very, very clearly stated number of shares you plan to issue, okay? I might even be able to show you some, okay? Just by way of example. Um, China merchant. So they came to the market. Number of shares offered under the global offering. You have to be very, very clear. That is the number. Right? 891 million shares subject to the over allotment option. Now, this, it seems to me, has been confusing the hell out of a lot of people. I'm now going to try my best to unconfuse you. Okay, so that 800 something number, 891 million, is equivalent to this number here. Okay, everyone is okay with that? Now, when you do an IPO, you are allowed legally to issue an additional amount. Typically, it is 15%. I don't think it must be 15%, okay, but the standard practice is 15. So that means although the stated issuance in the prospectus is 100, in reality, the final outcome is going to be a range between these two numbers. It cannot be smaller than this, okay? That is what the underwriter is there for. So if no one buys these shares, that will be a totally lousy IPO. Then the underwriter has to take them up and then pay the issuer. So you know at a minimum it will be 100, but it can be 107, 112, it can be 115. Okay? Is it everyone is okay so far? This part is important because if you are lost here, you may be lost for the next 8 weeks. Okay. So I told you earlier, well, we got a situation. We have enough orders for 500 and we can't allocate 500. We can allocate 100. Well, we can at least allocate 115, which helps a little bit, not much, okay? But they will do that. They will do that. So you have orders for 500 shares. You're going to allocate, you are going to sell not 100 million shares. You're going to sell 115 million shares on day one, okay? Now, how do they allocate that? You might be asking. Because you have different people giving you different prices, haven't you? Okay. Now, you can see immediately, just by a very simple example like this, and normally the process is you have this syndicate, and that's what they're called, the equity syndicate, okay? Syndicate means there are representatives from JP Morgan and then from Morgan Stanley. Which other example was I using? Citic Securities. So all these people, they sit around in a table all night, probably an overnight thing, okay, with a lot of coffee. They have discussions. It's not very scientific, okay? Do not expect there is some kind of formula, okay? For example, if the syndicate agrees that they will issue shares at $10. Okay, you can only have one price. Then client 1 can buy, and client 2 can buy, and client 3 can buy, because client 3 was quite happy to buy at 12. So of course they'll be happy to buy at 10. Okay. Now, if you decide to issue your shares at, let's say, 11, let's say you do, okay, then client 1 is not going to get anything. Client 1 might ring up and start complaining. You just say, well, I'm sorry, okay, but you want to buy at 10. And then our syndicate decided we should price it at 11. That is why there is normally a price range. Okay, so the guys, the senior bankers, just of course the client will be there as well, the corporation. So they have a say in all this. Okay, so the client will be there, the company, the issuer will be there, and they will calculate, uh, just exactly how much money will be raised. Now, of course, you're wondering, why don't we price everything at 12? Well, you can if there's a lot of demand, if there's a client for, okay, and they want to buy 20 million shares at $12. And if you have enough people like that, just ignore these guys. Are you with me? Yeah. So it's kind of like an auction bidding process. Okay. So like I said, there's not really a formula, and it's a lot of negotiation, and it's by experience. You want to price something reasonably. If it's too low, it's not good for the company. If it's too high, it's not good for investors. Okay, so it's a question of balance. Now, once they have done that, so they would allocate not 100, as I said, they will allocate 115, and that happens literally. So I should say over allocation. That happens like 12 hours before an IPO. Okay, so you have collected all the institutional and all the retail orders. You now have all the numbers. You know all the demand, all the prices, and the amount of subscription and so on. So literally 12 to 8 hours before the IPO really goes live, you will decide on a price. Almost the night before. Okay. Everyone is okay? The first price, the listing price, the first price, in fact, that is the price where you would sell to all these investors, whether it is 10 or 11 or 12 or $11.28, whatever. Okay, the first price. IPO debt. I didn't say IPO. Oh, the date. Okay, that is the listing date, the day when you can start trading. Okay. To give you a simple example, I saw this morning this company. I'll give you a real example. NEO IPO. You know about NEO? Five days ago. So this is from CNBC. Shares of NEO, the Shanghai-based Tesla rival, have surged since debuting in the public market last week. Debuting means coming to the public arena. Okay, I don't know exactly when they listed. It was sometime last week, wasn't it? So IPO date means the actual date when you start trading. Okay. So from that point onwards, you are a public company. Now, something interesting happens after the IPO date. Okay. That is, during this period, you have what's called the price stabilization. Which is normally 30 days after subscription closed or something like that, or 21 days after the IPO. It's anyway, huh? Is it? Yeah, 21 days. Okay, but anyway, I'm not so concerned about the actual number. I'm concerned with the concept. Okay, uh, and then at the end of that is when you have this so-called over allotment. Oops, over allotment option, sometimes called the green shoe option, whether you want to exercise that or not. Exercise or not. Now, is everyone okay with that so far? You still follow me? Um, if you really want to have a timeline, okay, I would say the clawback is what happens first, and then the over allocation really happens much closer to the IPO, and then followed by a period of trading, typically 21 days, and the last thing would be the over allotment option. Now, instead of getting worried about these terms, I encourage you to think of, steps 1, 2, 3, 4. Especially people are a bit confused between over allocation before an IPO and the over allotment option after the IPO. Now, the two of them are related, but they refer to different aspects of your capital raising exercise. Okay, now let me clarify what I mean by that. So the over allocation, okay, is something that issuers do on purpose. On purpose, it's allowed by law. You are allowed to do that. You are allowed to go around telling the whole world, okay, I'm going to issue 100 million shares, but I intend to allocate another 15% on purpose. You will say that in the prospectus, okay? Now that is over allocation, okay? Effectively, it means there is a flexibility. Any number between 100 and 115 is possible. It would not be smaller than 100, it would not be bigger than 115. Okay? Are you okay with that? Yeah. Normally, that is what they do. Yeah. She's asking me, where would you get the extra 15 million shares? Because you don't know whether they will be needed or not in the end. So you can't really print them in advance and then just tear them up. So normally they would just borrow them from the existing, the major shareholder. Okay. Well, let's say the cornerstone investors is one possibility. Okay, I think it's not limited to that. It would depend on what kind of company you're running. Let's say, imagine Facebook. Okay, so Facebook is owned or was substantially owned by Mark Zuckerberg. So when they did an IPO, so previously he owned almost the entire company, and then he sells a part of it. But if you want to borrow shares, you probably can borrow from him. That's an example. Okay, so it can be the cornerstone. Basically, you borrow from anybody who has a lot of shares. Okay, and by the way, while we're on that point about where the shares come from, Okay. Um, my view is that this stuff about over allocation is important. The concept is important. It's standard market practice all over the world. It's done in Hong Kong. It's done in the U.S. in Europe. Okay, that concept is important. The question you asked me just now is more an operational detail, if you see what I mean. Now, it is important to understand. It is important. Okay, but I think that the the nature of the question to me is somewhat different. Okay, so that is an operational issue where the shares come from. Okay, now, so everyone is okay with that? Yeah, sure. Okay, um, good question. Yeah, yeah. I know what you're thinking. I have a question. Uh,
I don't think it's a high spot after the stabilization. I mean, if the price is higher than the final offer price,
yeah.
and the coordinates will not exercise the option.
Mm-hmm.
So it still is a process of stabilization.
Uh, you could say that it's the last step, is the conclusion, if you like. But you need to single it out because something specific. You're talking about 3 and 4. Yeah, 3 and 4 are part of the same exercise, but 4 specifically is the conclusion where you need to take some extra action. Okay, are you with me there? So, what is your question actually? You, I never say they were. They are not independent, but one follows another. 4 depends on 3, if that's what you mean. And if you were if you were thinking of that, then I do agree. Yeah, yeah. Hmm. If the option is not exercised, well, I'm coming to that in a moment. Okay, this for someone who's coming to it for the, you guys are already doing quite well because this is something that is done by professionals with 10, 20 years experience. You don't even have 10 weeks of experience. Okay, already we're talking about very complex capital market practices, but let me come to that in a moment. Okay, the so-called price stabilization is a label that I've given to a period of time when the lead underwriters or the lead managers have an obligation to try to manage, um, I almost say manage trading activities of that stock. Now, I'll come to that, okay, if you just be a bit patient. Um, Now, someone asked me just now, where do those new shares came from, right? So what you do is, are you thinking of if there is no new shares issued, or what is that? Can you just clarify a little bit what you were saying just now? Yeah. Okay, I see what you mean. All right. No, so let's say this was your, okay, it actually, I can reuse this diagram. So you got assets, liabilities. This is equity. Now, so let's say you, okay, I'll make that quite clear. So you sell, you sell 200 million of old shares. And by now you should know what that means, secondary shares. And you issue 100 million of new shares. Okay? So I don't know what you're going to do with that. So maybe you put it away as cash. It's not important. So totally, there are, so in your IPO prospectus, you are going to say that there are 300 million new shares available coming to the market, but because of the over allocation, you are going to allocate 345, aren't you? Yeah. Now the question, in fact, this was similar to the question that was asked earlier. Okay, where does this 45 come from? Now, if everything works out well, then after the IPO in 1 or 2 months' time, if everything works out and you really end up selling 345, then you would have issued an additional 15, and you would have sold an additional 30 from existing investors. Correct? Okay. Now, but I said, on the IPO date, you don't really know whether you are going to be doing that or not. All right? It's a big question mark. So what you can do is you just go to the existing shareholder and you borrow from them. That's one way. In fact, that is a much simpler way. It's a simpler way operationally, and it's a simpler way for you guys to understand. Okay. As to all that talk about borrowing from this and that cornerstone investor, I ask you, don't worry too much about that. Do you understand what I'm saying here? Yeah. And it really happens. Okay. Now the other way to do it would be, well, you are selling 300 million shares. Maybe there's a big dude out there who bought 50 million. Maybe Warren Buffett or Bill Gates bought a new investor bought a lot of shares. Okay. The way you can do it is you tell this guy, look, you are going to be in a lockup period anyway. You cannot sell in the next 6 months. So how about you pay, but I don't give you your shares yet. In other words, I'm borrowing them. So maybe I give you 5 million shares. Where's the other 45? You lend them out for the purpose of over allocation. But like I said earlier, don't get too obsessed about where the shares came from, because it's not really, in terms of importance, is a lot less than the concept of over allocation itself. Are you with me? Yeah. So I'm happy you asked that question. Fine. Okay. In your mind, just be clear what is top priority question, and what is an operational detail. Okay. It's okay. You're still asking on that. Yeah. Yeah. Well, it will be. It will be after the after everything, after the dust settles, as people say, okay, and you know whether there are going to be new shares issued, then they will issue the new shares. So on day one, maybe not, but on day one, only 100 new shares are issued, and only 200 old shares are actually changing in ownership. So the answer is yes to your question. Yeah. Is it okay? Talk to me now. You still don't, do you get it now? The easier way to think is just that they borrow from the existing majority shareholder, okay? I'm trying to make your life easy, okay? This red part, they borrow from Ma Yun, they borrow from Bill Gates, they borrow from Mark Zuckerberg, whoever, because there are a lot of shares that they can borrow, they can lend to you, all right? Thinking about where the shares come from, it just confuses the issue for no particular purpose. Are you okay with that? The red box. It's okay? No, the red box, no, this is what you are selling. The red box is something else. So maybe, sorry? They borrow from the existing majority shareholder. Yeah. Can you explain to her? You can talk in Putonghua if you want to. No, go on, go ahead. You know, they've done a survey in Harvard. The best way for students to learn is to ask one student to explain to another one. I'm not asking you to do my job, okay, by the way. It ends up helping you both. Okay, what? Yeah. Yeah.
It's about how to retain back. After the IPO, if the price is lower than the order price, then the underwriters can buy the shares from the market and retain it back, and they can earn some money. But if the price is higher than the first price, what can we do to retain all the shares?
If the price is higher, then the broker should not have to do anything, or should not do anything.
But
Yeah.
for example, the 30 borrow from the cornerstone investors.
Yeah.
So the underwriters should retain it back after the IPO. Yeah, where
Okay. They return it back. They return it back by precisely exercising the green shoe option, which means they will get additional shares, and then with those shares, they pay them back. So it's like I get, give it to me, I give it to you, like that. You asked a question which is several steps ahead, which some other people might have missed for now, but it's okay. At least I want to answer you. Is it okay? Yeah. All right. Now where was I? Yeah. The easiest way to think of it is you borrow shares. Who do you borrow from? You borrow from anyone who has a lot of shares, which can be an existing major shareholder. You want to borrow shares on Tencent, who has a lot of Tencent shares. The Ma family, okay? Or you borrow from somebody who has actually bought a lot of shares, knowing that they can't they can't sell anyway. So it's just a question of whether they put it in under their bed or they lend it to somebody else. Okay, now so that is the IPO process in a nutshell. Yes.
One more question.
Yeah, sure.
You mentioned about to pay some interest for the money they borrow, or if they can't for the dividend, do they still count the base they borrow the money from borrow the equity from the investors?
Okay, that's a very good point. He's asking, I can answer that question in a more generalized manner, which is when you borrow the shares from somebody, it doesn't matter for what purpose, okay? You borrow the shares, do they have to pay anything? Well, since we live on a planet which is driven by rational economic agents, in this planet anyway, okay? Whenever you borrow something, anything, okay, people are going to say, why should I lend it to you? So there normally is a fee. There is a fee, okay? And the fee would be negotiable. The point to remember here, however, is if you go to Ma Yun, so they're doing the IPO for Alibaba, and you ask Ma Yun, well, can you lend us some shares in order to facilitate the over allocation? Now, he should be very helpful because in the end, he's helping his own company. So it is in his interest to see that this process is executed very smoothly. So yes, he might charge something, but he's not going to charge you the sky for that. Yeah. You see my point? Yeah, but there is normally a fee, yes. Yeah. Yes. Hello. I'm really sorry, I couldn't hear you too well. So when would the underwriter lend to the? When would they borrow? When would they borrow? Okay, very good. That's the first question, right? What was the second part? That's only one question. Okay, now, all right. I tell you what. Let me draw the flow. Let me draw the flow for you on the actual IPO day. The actual day, first day of trading. Okay, so imagine there's an IPO which happens today. I'm going to show you what happens at 4 p.m. today. After the first day trading is concluded, what happens? Okay, so IPO day. So end of first day of trading. So it is now 4 p.m. So things have to settle. Shit, what are we going to do? Okay, here is what happens. So the company, now what did we say above? So the company is selling, I'm going to still use this example here of, so there are 345 million shares, 1, 2, 3, 4, will be sold. So these are the iBanks. This is the company. The company will sell 200 million old shares, or sometimes called secondary shares. That is why I was so keen to explain to you last time the difference between primary and secondary shares. Now, are you okay with that so far? Okay. Okay. So let's say the iBanks will sell to the market, and I'm going to split that up into different parts. So this is the entire market. So there is the institutional tranche, there's a retail tranche, and let's say there's a big cornerstone investor. Now, you may, by definition, want to include him or her as part of the institution, but I'm going to just single it out, okay? And let's say the cornerstone investor is buying 50, okay? And then institutional gets, I want to put some sort of realistic numbers to it. So let's say the split between institutional and retail is 70-30, okay? So the retail will get 345, not 300, 345 million times 30%. What is that? What's 30% of 345? Now, if you are confused right now, we are on tape, so you can go home and review it if you want to, around the 52-minute point. So the retail will get 103.5 million shares, and then the institutional will get 241. But I'm counting the cornerstone separately. So this is what might happen, okay? So by cornerstone, I mean sort of non-retail if you want, okay? So these two, I'm classifying them both as institutional. Now, you can see there's a problem here because there are 300 million shares coming in, but they are selling 345. When you add them together, it's 345. So operationally, you are going to run into a problem. You won't settle. Settlement will fail, okay? There are two ways to deal with that. One way, the simple way, is if a majority shareholder, someone like Ma Yun, okay, basically lends an additional 45 million to the iBanks. Now we can settle. Now you got 345 coming in and you got 345 going out. Now that's one way, okay? The other way, I think that relates to your question, okay? The other way is, all right, you settle this one, okay, I sell you 50 million shares, but you lend it back to me. You lend me back 45. Now, when you add up all the arrows, so now this doesn't happen, okay? So what have you got? You've got 300 million coming in, okay? You've got 345 going out, but you got 45 coming back. So it will settle. Are you with me? Yeah? So this is a lending. This is just a lending. Lending means, okay, I lend you this. What does that mean? You can have it, but just return it back to me in exactly the same form that you find it, okay? If if things start growing in there, okay, I want to have that too. You know what I'm saying? Just keep it and then give it back to me. So now it will settle. So effectively, it is channeling back some shares from the cornerstone investors so they can go out to the other people who neither cares or know about this over allocation. All they say is, I want my shares, that's it. Are you with me? I think I have kind of answered your question now. It's okay? Sure? But like I said, the other way is a lot simpler, okay? And that's what Rose K is going to be telling you. Okay, she's asking, how are we going to treat this 45 million shares? What happens to the money? Now, that's a very good point. And do remember that this 45 is in fact 15% of that 300. Now, not $300, 300 million. Okay. And where does this 300 million come from? Well, 200 are old shares, 100 are new shares. Okay. So to answer your question, there is actually an element of uncertainty until 21 days later. Now, 21 days later, one of two things can happen, okay? Either the IPO was very, very successful, so you decide to sell an additional 30 million from the existing shareholders and an additional 15 million of new shares. So maybe that happens. In that case, the existing shareholder will get some extra money and the company will get some extra money. Either that, or if the IPO was not a very good one, and they end up not really issuing or selling these new shares, then the company does not get new funds, and then the existing shareholders will not get additional money in their pockets. Is that okay? Was that your question? Yeah. It's complicated, but it's fun, isn't it? You guys are all experts now on IPO, half experts. Okay. Now, the problem is we haven't actually touched on the in-class assignments. We have talked about this. We've talked about this. We've talked about this, and I think we talked about this. Know that, and here, so now I come to my notes finally. Okay. I want to, don't read it yet. I'm going to animate it. Start on click. Okay. So I think over allocation is what you do shortly before an IPO. Okay, hold on a second. It is intentional. It is an intentional and it's a perfectly legal technique for banks to create additional demand. So there's 15% more demand than the supply, and this is perfectly legal. Now, since there was additional demand that the iBanks have created, they are net short. They are short by 15%. And all your questions that you've been asking just now about where the shares come from, who do you borrow from, what does the cornerstone investor do, they all have to do with point number 2. Okay, the iBanks are short. If you're short, you can't settle. Okay, and a net short position has to be covered in 2 ways. So either you buy back from the market. Okay. Now, when I say short, because you borrow from somebody, so that 45 million shares that I told you about, although now your settlement is successful on day 1, you have to pay them back. So someday you're going to have to find those shares from somewhere to pay back either the majority shareholder or the cornerstone guy. Okay, so either you buy them back from the market, or you ask the issuer to issue more or sell you more. In that case, it's called exercising the over allotment option. Is everyone okay with that? The underwriter use their own money to buy back from the market. Sorry, what was that? Who said that? Someone, was it you? You're right, what you just said. Okay, I'll keep it simple, and I pretend that the shares are borrowed from an existing majority shareholder. Okay, in the end, it doesn't matter. Okay, but let's say it is just to keep things really, really simple. So what you have is now I do the math for you. Okay, so this is a company. This is the iBank, and this is the majority shareholder, major shareholder. It just makes things easier to explain, and it doesn't change the big picture. So you're going to get 300 million shares. And then this guy is going to lend you another 45 million shares. Now, how much money will you collect? You are selling to the market 345 million shares. So the money that you receive on day 1, if the shares were $10 a piece, okay, you actually have received 300 million here and 45 here, and then you are selling 345, and then you will be receiving this amount of money. So you have the money. So he's right, because of the over allocation. If you were only selling 300 million shares, you should be receiving only this amount of money, okay? But that additional amount is what you can use to buy back the shares if you need to. Okay? I enjoyed talking to you guys today. I mean, I always do, but today I enjoyed even more because there were so many questions. and that makes my job a little easier, and it makes life easier for you as well if you tell me what you don't understand. Okay, I want to show you a couple more things. Now I actually created a little spreadsheet which I think I will put online, but this one is just a breakdown of in-class assignment number 4, part 1, part 2, and part 2A. We already did that last time. And then 5 is actually quite simple, so I didn't, anything to do with true and true false or definition, I haven't done anything. But assignment number 6 is, or in-class assignment number 6. Okay, I was really planning to go through all that, but I wanted to answer your questions as a priority. But let me very quickly go there. So assignment number 4, we already opened that. Okay, so this is the one. Okay, we almost sort of talked about all of that. To try to go through these, because your homework or your home assignment and your exams will look like this. Okay, so if you can do these, if you have mastered it, then you are in good shape. In the end, it all comes down to old shares versus new shares, who has increased ownership, who has decreased ownership, whether there is any green shoe, and so on. Now the other one, in-class assignment number 6. So 5, I didn't bother. Okay. So this one, number 6, I was going to go through it with you, but I think the numbers, they are kind of self-explanatory. Okay, so you have the old structure of the company. There's a majority shareholder, there's a minority shareholder, and then number of shares. Okay, number of shares, and then a new structure over here. So if there is no green shoe, this one should say with green shoe. I'm sorry, with green shoe. Okay, it looks like this. And I think if you look at my numbers, and if you can understand what is going on behind these numbers in connection with the in-class assignment over there, if you can do that, I think you won't have any problem with the home assignment number 1, because I looked at that too. Okay, so why don't you have a look at that and let me know if you have problems. Okay, now, like I said, I did receive a question from one of you who very kindly wrote to me and even showed me a spreadsheet. And I want to thank this person. It's Reno, I think. Are you here? Hi. Have I helped you a little bit, or have I confused you even more? I hope I have helped you a little bit. So he will get some participation points too. He very kindly supplied me with a spreadsheet, and I'm struggling to open it. What? No, I could open it this morning. How come? Dear. No, there was. I'm trying to open it here. Okay, so he showed me a spreadsheet regarding over allocation, and this is exercising your over allotment option. See if I can download it again. Save. Okay, that's better. So he was basically asking me why would a company do these things? So over allocation is compensate the clawback. No, I don't think that is the reason. They have a certain flexibility when they do the over allocation. So you will never know whether the final amount of shares sold will be 100 or 115. There's always some flexibility in that. Why would they do clawback? Give retail investors more stock. That is true. Green shoe stabilize the stock price. Yes, I agree. Who is the issuer? Lender. The lender? I guess you are talking about the lender in this over allocation exercise. Yes, you see, somebody else already had this idea. Either the major shareholder, majority existing shareholder, or the cornerstone investor. Anybody who has a lot of shares, you can borrow from them. Okay. Clawback is not really related to the stock lender. Who's the buyer? Global coordinator. Well, the entire syndicate is responsible for distributing the shares to the entire market. Primary or secondary stock. Over allocation can be primary or secondary. Okay. It depends on if you are issuing only primary stock, then you're going to over allocate primary. If you are selling secondary stocks, you'll be over allocating on secondary. Okay. In what condition is this exercise? Yes, this is correct. Okay. Subscription rate is higher than what? Define. Well, if it's oversubscribed, if more people want to buy than what you have, then it's oversubscribed. Okay. What else? In what condition is the green shoe exercise? The stock price is lower than, or the price is too high. No, the green shoe is exercised when you need more shares from the issuer, and typically you need more shares when the IPO has gone well and there's a lot of demand in the market, and you will need more shares normally when the price is very, very high. Okay? When the price is very low, you just buy the shares from the market. Okay? When is it exercised? 30 days after the end of it? Yeah, I think so. Exactly on that day. Yeah. Number of stocks in the process, 15% of global offering. It is true. Should it be exactly 15 or is it the maximum? I'm not sure actually, but all the IPOs I've ever seen, they're all 15. So that could well be, I think you can say 12 if you want to, but for me that's not really important. Money per stock when exercised. No, not it's the IPO price. Okay, you over allocate, you are selling at the IPO price everywhere. The initial price. I don't know what you mean by final price. Okay. Sequence of the three, which happens first. Probably, yeah, clawback, you would know pretty much 1 week before, and then 1 week before the IPO. Over allocation. Well, that is an intention, but you physically over allocate like 12 hours before an IPO. And then green shoe number 3, correct. Yeah. So a lot of these things you have the right understanding. Okay. Brief description of the process. Well, we've been talking about that all morning. Okay. Is everyone okay with that? I hope it's been beneficial. I hope I've cleared up some confusion. But like I said, I actually wanted to go through this with you, not this, on your left hand side. Let me quickly. I mean, if you have questions on any of these, feel free to write to me. So here, in this case, in the assignment number 7, you have a company that was entirely privately owned with 3,200 shares. I'm going to ignore the million. And they are, what are they going to do? Okay, they're going to transfer. So all the shares are up for sale, but they're going to transfer 100 shares to the National Social Service or Social Security Fund. I'm sorry. Yeah, I'm sorry if you're sitting over here and you can't see it. Yeah, this question is interesting in the sense that okay, I'll tell you what's going on here. And I'll tell you why I said this question is interesting. So the way you look at this, so there's a company. So this is, after this, I'll let you go. Okay. So they have some equity. And in fact, they're going to issue more. And they're going to list all the shares, but they're going to issue an additional 1,000. So that actually comes with a green shoe, which is 150. Now, I told you earlier that when you say you're going to issue new shares, there will be a range between this number and 115. So it'll be somewhere in between. If it's a really happy ending, it will be this one. If it didn't go so well, it would be this one. In the case of this company, it's actually somewhere in between. So the total final number of shares that are issued is actually 1080. And you can see that with this here. Okay, so that is why the share ownership of this original owner has gone down by 100 because they had to allocate 10% to the state security fund, but it's gone down another 8 because there were another 80 million of new shares. And so that's their ownership. So there are variations on the same theme. The theme is know what your numerator is, okay, numerator, denominator. So has that gone up? Has that stayed the same? Has that gone down? Well, it won't go down, okay? If you issue new shares, then the total number of shares will go up. If it's just secondary shares, then it just stays the same. Numerator, are you an existing shareholder? Has your ownership been diluted? By how much? Okay, you answer those two questions and you get the answer like the part that I've selected on the left-hand side. Okay, in any case, so I think I did in-class assignment 6 and 7. So 7 is right here. Okay, so I have outlined the old structure. It's not much of a structure, just one entity. The new structure and the number of shares, okay, and then the new structure, the actual ownership, which is on the right-hand side. Okay? So I will upload this spreadsheet for you to have a look at, and I think you should be okay afterwards. All right. I know you will be, because people were okay last year. So why shouldn't you be okay? You're just as intelligent. All right. But feel free to write to me if you have any other problems. Otherwise, I think I should let you go. I've kept you for a very long time. Okay. All right. Thank you. Now, there was somebody else asked a question, didn't get $1. Who was it? Yes. So feel free to come up here and claim your participation credit. If you have not signed in yet, here it is. Otherwise, we will meet again next week on Tuesday. So actually in a week's time, okay? So next week on Monday, please don't come here. Okay? Thanks everybody.